This is probably the biggest and most important week of the United States economy in 2022. Not only for the stock market, but also for crypto. Stay here. Let me show you why. My name is Darwin Fortuna. I started investing in crypto and stocks and different things a couple years ago. Got destroyed just like many people. And I'm here just to tell you the things I did that you shouldn't do, and the things I'm doing now so that I can make it through. Never financial advice. I'm just a licensed architect that happens to invest in crypto. This channel is both in Spanish and English. So if you're a Spanish speaker, please stay tuned. There's another playlist that you can watch. Subscribe and stay tuned now. Let's go take a look. So why did I say that this is one of the biggest, or if not the biggest week in the economy of the United States? Well, let's start by looking at the problem we have right now. As you guys know, we have inflation. Inflation has been caused by, one, the problems with supply chain that we had all the way back when we couldn't do anything. Everything was in lockdown. And the other side of the spectrum of inflation, which is too much money. When there is a lot of liquidity, a lot of cash, a lot of money, buyers are going to buy. And if the goods aren't being produced in a way that's sustainable or that can meet the demand, then the prices of those goods are going to rise. Because if there's only one of this and everybody wants it, I'm going to have to sell it really high, right? That's just the way it works. So when we were in lockdown, we couldn't buy anything, we couldn't get anything, we didn't have an opportunity to get our goods to us. But at the same time, the government started printing money and putting money into your bank accounts, which you all were very happy and pleased. Hey, we liked it. But now we get the results of that. Everything that you get in life comes with a price. The price that we got from being locked down and not being able to work or produce goods and get money is that inflation rose all the way up to 9.1. Inflation is, again, it means that by 9.1%, whatever you could buy before, when inflation was at a 9.1%, you need 9.1% more money to be able to get the same goods. And the Feds, starting with the president of the Federal Reserve Bank, Jerome Powell, believe that there is not a good scenario or a good economy in which inflation is entrenched, in which inflation prevails. That is not good for anybody at all. If you haven't watched my video, Jerome Powell had a meeting not long ago. It was on November 30th. And I have it, and I'm going to probably click it right here. It's called All You Need to Know from Jerome Powell's Speech. 5 very important things. That said, there is a week, this week, the best week, the most important week. And this week, we're going to have a Federal Reserve Bank meeting. I'll tell you more about that in a second. So let's go back to the problem. What do we do to reduce inflation? Well, the Federal Reserve can only control one thing: money. They can only control monetary policy. They can only control the money supply because they make the money. Federal banks in every country make the money. They supply the money. They can either take away money or print money. Right? So that's how everybody gets money. Even the government gets the money from the Federal Reserve Bank. Supposedly the Federal Reserve Bank is independent from the government. It's a little funny because they do get appointed, but I'm not going to get into that. So they're independent, they print money, they make money. So because they can't control supply chain and they need inflation to go down, and they have a mandate, and I have to talk to you about that mandate. They have a dual mandate. Maximum employment, 2.0% inflation. Maximum employment, 2.0% inflation, right? So it was a 9.1. They need to lower it, and they've been lowering it by increasing interest rates. You guys have noticed interest rates have been going up. I did a little research very quickly, and in the last 25 years, we've had 4 major interest rate hikes, and we are in the third highest. In the 2001, we had interest rates as high and above 6.5%, 7%. Really high. Between 2004 and 2008, we had interest rates go as high as 4.5%, 5%. And now we are at 4, and we've only gone through the first year of interest rate hikes. So we are, as of right now, the third most hawkish and most bold moves in increasing interest rates by far, right? The third one in history. If you go back to the last 5 years, this is the highest in the last 5 years. The 10 years, this is the highest in the last 10 years, right? So in over a decade, we've been the most hawkish and the most, they call this quantitative tightening, the most tightened in 1 year, in just 1 year. You see the interest rate hikes. They've been gradual over the course of several years. They were a near zero for a while, and they've not been gradual this year. So this has an inverse relationship or correlation to the stock market and crypto. And that's why we've been suffering so much. So going back, they can only do this: increase interest rates and or lower them, right? They can only control the money supply. They cannot control the supply chain of products and goods and services. So that said, this week they have a meeting. But before that meeting, interestingly enough, they're going to get a reading, a fact, a number for where inflation is. And they look at two kinds of inflation. They look at consumer price index, CPI inflation, and they look at core inflation. Consumer price index is not the one they really love the most. That's the one I was looking at right now. It's not really the one they love the most. That's the CPI inflation. Because it includes a bunch of different things. It includes everything, right? Prices of gas, real estate, food, clothing, services, everything. They like core inflation the most. They like core inflation the most because it excludes energy. And it excludes food because they're very volatile, right? So energy, gasoline goes up and down depending on whatever happens anywhere. But they exclude all of that, so they are focusing on core inflation. And we're going to be getting a reading on December 13. On Tuesday, December 13, we're going to get numbers for core inflation and CPI inflation. All right? For the month of November. Okay? So put your calendar right now and set up the timer for 8:29 or 8:25 a.m. where you're going to be getting the numbers at 8:30. And you're going to see a reaction in the markets. It's either going to go boom through the moon or it's going to tank slightly. I don't think that there is a lot of downside. Now, again, I'm not giving you financial advice. I don't think there's a whole lot of downside. Why? Because we've gone so low that there's just not enough people to sell anything anymore, right? So people are just sitting in the silence with their cash, ready to shoot, ready to do something with it, right? So, and we know our cash cannot just be sitting around because it's losing value due to inflation. So that's one of the big ones that we have. We have on Tuesday, December 13th, we're going to be getting at 8:30 a.m. our inflation reading. What's being expected? We had a 6.3% inflation last reading for October. We believe it should be at 6.1%. That's the consensus. That's what we're expecting. But it will probably likely just be 6.2. And if all of that reads, a 6.1 will make the markets rally. A 6.2 will also make the markets rally. A 6.4 or 6.5 will cause trouble. A 6.3 will just keep things exactly as they are. Nothing changes. CPI inflation, right? I showed you CPI inflation before. It's right here. Right? So it's 7.7 right now, right? So that's the reading for October. So if we have a 7.7, people are really positive. They think that a 7.3 might be the case. But the conservative side says we'll be fine with a 7.6, which is a just 0.1% lower. all of this is positive. What we're expecting is positive. We're hoping that inflation is coming down, that the interest rates that have been going up starting in March with just a little funny 1/4% increase, and then we went up to 0.5%, and then we went up to what we've been doing consistently, which is 0.75% every single meeting. They're hoping that that's been doing the work. And the way that the interest rates work, they don't have an immediate impact in inflation. It's a gradual, let's say 6-month kind of thing. So all of the results we see right now are a balance of supply chain actually being resolved, like truck drivers moving goods from one place to another and things like that, which is mainly due to the fact that we're not in lockdown, we're not requiring any vaccines anymore, like things are open, right? We're open. And the other one is the fact that we've been increasing interest rates, right? So those are the two ways that we're being, positive. These are months of, seasons of spending. A lot of people spend a lot of money. So we'll see how November played out. And we're going to get those numbers this week. And then, real important, then on Wednesday, look, it's in red. At 2 p.m., we're going to be getting the Feds giving us, they're going to be meeting since Tuesday, Monday, Tuesday. They meet before. But they give you their decision after that, right? And, I mentioned to you that I gave you really the top 5 things to watch out for Mr. Jerome Powell. It's a video that I published on November 30th. So go watch it. It's got all you need to know from Jerome Powell's speech. I'm surprised he only has 52 views. It was really well done. So go ahead and watch it. And what we are expecting is that their decision will not be to increase interest rates by 0.75%, but actually to increase interest rates by 0.5%. 0.5%. Why is this so critical? Why is this so important? Okay, I'll explain it right now. And this is what consensus is saying. We're expecting 0.75%. This is what Mr. Jerome Powell himself told us that he was going to do not too long ago, right? We're talking about not even 10 days ago, right? So 11 days ago. So he told us that they better slow down in the way that they increases interest rates right now. And that it's appropriate to reduce interest rates. So I'm not going to give you more on that. Go watch that video. But that's what we're expecting. But here's the thing. The market's a little scared. He said that 10 days ago, 11 days ago. We're getting a CPI reading for November the day before they talk. Or the day before they give us their decision. Unemployment has been steady. We haven't had any problems with layoffs. We haven't had any problems with in fact, we have a strong labor market, right? And remember, their job is price stability, 2%, and maximum employment. 2% inflation, maximum employment. If employment is still great, it means there's still money and there's still people to work and there's still things going on. And well, it is like a 30-year low. So it means the economy can still endure the pain that we're giving it. It's ironic. A great economy, a great employment rate is actually negative for them because they're going to be hurting all of us and taking money out of the market. So that's it. We're expecting 0.5% increase. But if the CPI reading contradicts what we're expecting, we already got a really amazing labor report. And if the CPI reading shows that inflation is going up, these guys are going to say, no. We're going to have to go back to 0.75% again. And that's going to cause so much pain. It's incredible. So we are now in a balancing act, right? They are in a balancing act, but we are now as investors thinking, do I go in and put some money in anticipation that inflation is going to come positive? We're all expecting it to be positive. And in anticipation that Jerome Powell is going to not go up with interest rates. All right. And if they reduce the rate by which they're increasing the rate, oh my gosh, that's so weird. If they reduce the pace by which they are increasing interest rates, people call that the pivot. The pivot is we're increasing by a consistent amount of 0.75%, and then suddenly we are increasing interest rates by a lower amount. Okay? So we're still gonna go up, but I think this sketch was not, don't judge me. I'm a licensed architect, but that wasn't a good sketch. So if we're increasing interest rates by this, and 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 then suddenly we start doing this, and this, and this, that's a turnaround moment. That's called a pivot. All right? So that's a turnaround moment, and it may signal that either we're going to continue to reduce that pace, and 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 maybe go into the negative with the interest rates. And there is an inverse relationship between interest rates going up and the markets going down. So if the interest rates are reducing their momentum by which they're going up, the market's going to go up. That's what we expect. All right. So we also have some other news coming up this week, but those are the main things. Tuesday and Wednesday, guys. That's all you got to look for this week. There's not much more that I would want you to see. So, and all I want for Christmas is that the Fed slow down in the pace of increasing interest rates, and that we get an amazing CPI and core inflation reading on Tuesday. And that's all I want, and that's all you should be prepared for. Stay tuned. Let me know if you like this. Subscribe to the channel. And I'm going to be producing bangers every week, every day, all the way through the end of December. I'm going to be producing videos, high quality content every single day for you. All right? So if you like this, subscribe, give it a thumbs up, share, and we'll stay tuned. Thank you so much.